Well, how you doing today, Ike?
I'm doing well, Mike. How about yourself?
Okay, it's been a few weeks since we last spoke, and one thing I know we really want to talk about because we both believe there's massive opportunity there. I believe probably better opportunity than just about anything, and that is how to generate alpha from investing in silver and how junior silver miners can be a call option on silver, offering the opportunity for 10 to 20 fold gains if silver experiences the same type of returns like we saw in 78 to 80, or even when silver went up to about $50. The silver stocks did really good going into that. But both of us, we get more emails and so forth probably from people about the stock market at this moment. So before we talk about the silver opportunities, what do you think about this rally we've had in the stock market, S&P 500, since late March? I mean, everything was crashing, and now, everything's going up, even though global economies are still pretty much shut down.
Mike, there are two aspects to your questions about the equity markets, the intellectual and the factual. The intellectual is this: the US economy experienced an unprecedented contraction due to a health crisis. The Fed and Congress implemented $6 trillion worth of measures to make sure that we get from point A, which is the bottom of this contraction, to point B, returning to how things used to be, without any long-term damage to the US economy. Looking at the market's reaction since the March low, it seems that equity investors have embraced the notion that the measures taken by Congress and the Fed are adequate to get us from point A to point B, in fact, sooner than later. And if more is needed, Congress and Fed will come through, and in the end, we'll get to point B with minimum damage. Many arguments against and for this can be made. Here at Market Views, like my good friend Meissner has made a convincing case for the positive scenario. Klein and Risky has made a case, very convincing one, for the negative one. Jim Walsh has made a case for something in between. All of them are very convincing. And I don't think on the intellectual aspects of it we can add something new. There are tens of thousands of YouTube videos regarding the same subject. However, what I can add is the factual aspect. And the factual aspect has to do with our proprietary inflows outflows indicator. Now, this is an indicator that over the last 10-15 years we have spoken and covered several times in our interviews. In fact, in our interview on June 28th last year, I discussed in great detail what is this indicator designed to do and what it is not designed to do. And for those who are interested, I'm going to include a link to the audio of that interview so you can listen to it. In that interview, I explain how we can extrapolate based on cash flows, potential reversal points for major indices like the SPX, the XAU, the NDX, the UX. In our update to subscribers on April 21st of this year, I discussed that based on this extrapolation method, the indicator suggested that the zone to look for a reversal was the 2,800, 3,000, 3,000 feet for the S&P. Because it would take a rally up to that level for this indicator to turn back to equilibrium. And if we look at the first chart, this is exactly where the indicator has been the last few weeks. We can see that after the spike of outflows up to almost the 60% area, we have come down to the green line, the 50%, which is the equilibrium. This is the moment of truth, because if you look back to what happened, for example, in 2019 at point A, this is what happens after we get a spike to oversold territory. We get a return to equilibrium, and then from there a new spike upward. And see what happened back in 2019 at point A. We're at a similar point right now. So this indicator, as I have said many times, is not designed to predict what flows will do. It's designed to predict what equity price will do based on flows going the same way they have been going. Going forward, we have two scenarios. Scenario one is that from current levels, from the equilibrium level, we get a reversal to the upside. In that case, then we're going to expect the S&P to rally up to 3,500. As unbelievable as it may sound to some, these are the facts. We get a reversal from the equilibrium point, the S&P is going higher. On the other hand, scenario two, if we get a spike in outflows from current levels, then we're going to expect the S&P to go back to about 2,800, 2,850, 2,700. Which one of the two scenarios is going to take place, I cannot predict. What I can tell you, we are at equilibrium. This is the time where either the bears or the bulls will prove their point going forward. I can say this, in bear markets, that is where rallies fail. So if this rally fails at this level, to me would be an added indication that we are in a bear market. On the other hand, if we break through it, as I say, we can go not only towards the all highs, but actually above them.
Well, one thing about both of these scenarios is that right now, the markets are drifting or consolidating, one or the other, and that's likely to continue, it looks, for several weeks, and then one of the scenarios will happen. And with the bear market scenario, I mean, the last two bear markets, the market would rally up to the 200-day moving average, S&P, or even go through it, and then drift for a couple weeks, then roll over. Sort of what it's done in the past, if that is what happens. But then again, there's a lot of excitement, obviously, many people right now.
Yes, and as I said, intellectually, you can make very valid arguments for one case or the other. The facts are, we are at equilibrium as we speak. And since we are at equilibrium, it means from this point, things can go either way. And what happens over the next few weeks, to me, will be a good indication as to what we can expect 6, 9, 12 months down the road. I'm going to ask you a question. Recently, you bought Bitcoin for the first time ever, correct?
Yeah, that's right.
Okay, I want to hear your experience, because looking at the charts, Bitcoin seems to be at a very interesting point.
Well, in 2017, when Bitcoin went up to 20,000 and had that final run, the 3 or 4 months into that peak, there was a mania about it. I mean, it was all in the news and it was everywhere. And I didn't buy any crypto or Bitcoin then. However, I will say I bought a few of these junk crypto companies that were mining the thing. The stocks were going up like crazy. And then I sold them in December when Bitcoin peaked out. But I wasn't a believer in it. I was just trading these stocks. But I didn't really believe in what the people were saying of Bitcoin, which is that, hey, it's going to replace the dollar because everyone's going to use it. And then it could even abolish central banks, and it's going to create a revolution. And this is what was the rationale people were saying to explain the move and why it could go to 100,000 or whatever. People had these crazy price predictions back in 2017, which obviously didn't happen. And then it crashed, went below 4,000, rallied back up above 10 last summer. Then it crashed this March. Then it's gone back up close to 10,000 as we speak. And each time it's rallied, these Bitcoin people that are true believers in it start saying these things. It's going to replace the dollar, blah, blah, blah. Well, I bought some not because I wanted to trade Bitcoin, but because I wanted to use it the way these people say you can use it. Because of this lockdown, there's not as much stuff to do, I feel. And over the years, I've liked to go on vacation and play poker. in casinos and so forth, and I can't do that. So I decided to open up an online poker account. But to get money into the account, I had to use Bitcoin. Buy the Bitcoin first, then transfer it into the account. Well, I thought, okay, that everyone says it's easy to do, so I'll go buy this Bitcoin. So I had to open up one of these wallets, deposit some money into it to buy the coins, and I thought, oh, I'll be playing online poker pretty quick. Well, that's not what happened. Instead, I found out that I was hit with like a $20 transaction fee that they took. And then they said I wasn't going to be able to transfer out of this Bitcoin for a week. And then it fell, another 10%. And then it came back a little bit. So what I discovered was, look, you can't replace money, you can't replace a credit card, and then it's not a good store of value. Those are the two things you need for something to be money. It has to be a good store of value and easy to use, and it just isn't. So it's just confirmation to me that these propaganda, whatever you want to call it, that people say about it isn't real. And it does has a use, but I think it's only speculation. I mean, if you can buy this thing and time it and have it go up, well, that's good for the person doing it. But, other than that, I don't see any point to it. And that's, for a real business, you can't operate a business like that. I mean, it's just crazy. But, we both like to use the charts because they're facts. And what Bitcoin has done since its existence is actually have a close correlation to the NASDAQ 100. And when the NASDAQ has gone up, Bitcoin has gone up more. And when the NASDAQ has had corrections, Bitcoin has gone down much more. So the same thing happened this March. The stock market fell, the S&P fell like 35%, and Bitcoin fell over 60% during that decline. So to me, it's just more volatile than the stock market. It's kind of like internet stocks were back in the 90s. It's not really, I don't think, separate from the financial markets. It's just a instrument of speculation. And so far in Bitcoin's existence, that's what it's done. And if the people that really believe in it, if their theories about it are correct, at some point, Bitcoin will go up when the stock market goes down, like gold has done at times. Bitcoin has never done that in its existence, though, whereas gold has. That's a huge difference. It'd be like me saying, look, I think IBM is a safe stock, but every time one day it's going to go up, even when everything goes down. It's never happened, basically.
Mike, I'm glad you mentioned it because the reason I asked about Bitcoin is because the weekly chart really brings to me memories of what happened to gold and NASDAQ after their parabolic moves ended. And it's the chart that we're going to talk about now. The one on the upper left is gold from 2008 to 2016. And we can see the pattern. It had the parabolic move, then the uptrend was broken, it bottomed, had a rally near the highs, and then it rolled over. Now the chart to the right is the weekly chart for Bitcoin. We can see the same pattern. It had the parabolic rise, it broke the parabola, it rose near the highs, broke down, and right now is maybe about to retest those secondary highs. Then look at the lower chart on the left. That's the NDX from 2000. We can see the same pattern. A parabolic move, the uptrend breaks down, we get the secondary high, and then it rolls over. Look at the chart to the lower right. Bitcoin. The similarities are striking. I do not know what's going to happen next, but I will share with our viewers what I do know. Looking at the chart, again, we have two possibilities. If you're bullish on Bitcoin, what you're going to see is breaking above this green line, breaking above the secondary highs. That will be an indication Bitcoin is going up to the old highs and beyond. If it rolls over somewhere between current levels and the secondary high and begins to go down, that's a bearish sign. It will be a confirmation that what we have seen is the secondary high and we're going to break the lows that we saw below 4,000. Whether you're bullish or bearish, I think what matters is take a look at the chart and see if the price action confirms your beliefs. If it confirms your beliefs, go for it. If it doesn't, think about it again.
My assumption is that it pretty much is just more volatile. It just amplifies the moves in the NASDAQ. In the fall of 2018, the stock market fell 20%. We've now forgotten about that. And Bitcoin got smashed during that decline, just like it did this March. So I'm assuming that the move in Bitcoin is going to be dependent on which of your two scenarios where the stock market happens. If the positive one happens, then it can rally. But if the negative one happens, it's probably going to be crashing before the end of the year. That's what I would assume at this point.
That's pretty much my assumption too.
It's so much going on in the markets, but Bitcoin doesn't work as a store of value. People need a store of value, not just business people, but investors too. And historically, bonds have acted as a safe haven, but now with interest rates at zero, you don't get anything from bonds except the fact that they're not going up and down in value because the Fed has kind of locked them in at the moment. So what can people use as a store of value, as a safe haven, so to speak?
Talking about gold being a store of value, I'm privileged to have known many people in this business who do quite remarkable and unique research. And with their permission, from time to time, we have featured some of their findings. 2 years ago, on April 21st, 2018, and for those who are interested, again, I am going to include the link to the interview from back then. We spoke about an extensive research on gold sentiment conducted by a couple of friends of mine who run a boutique research firm in London catering basically to hedge funds. I wasn't allowed to present the entire research, but I was allowed to show one of the charts that really got my attention. And at the time, both of us find it quite a bit unique. The sentiment survey that they're running, and it's quite extensive, actually were asking people if they are bullish or bearish on gold. If the answer was yes, then they were asked if the previous 6 months they had bought gold or they were planning to buy gold for the next 6 months, and if the base for the buy was speculation, event risk, store of value over the next 2-3 years. The chart that we showed back then showed how this sentiment fared from 2008 until the time we did the interview, which was, as I said, April 21st of 2018. As you can see from this chart, which is the same one that we showed back then, we had 3 different measurements. Those who were buying on speculation, by April 2018, pretty much they had given up. Those that we were buying for event risk also had pretty much given up after 2009 because nothing really had happened. But people who were buying with an outlook 2 to 3 years down the road, they had stepped up their buying between October of 2017 and April of 2018 when we did the interview. And 2 things were interesting to me at the time, which we highlighted. A, the same thing had happened between 2008 and 2009, and then gold went from roughly 800 to 1800. And if you look at the price action, which is the next chart, if they were buying between October of 2017 and April of 2018 when we did the interview, the low was 1250, the high was 1350. So it's a safe assumption to say that their average price, the average accumulation price, was roughly 1300, correct?
Yep.
At that time, I expressed the opinion that somebody is buying with a 2 to 3 year outlook. If you have a 8-10% drawdown, it doesn't matter if you expect 56% gain. 2-3 years later. And actually what happened following after that, we did have roughly a 10% drawdown. Gold went from 1350 to 1167, and then from point C at 1167 to now it has rallied up to, as of yesterday, 726. So if you were buying with a 2 to 3 year outlook back then, you had a paper drawdown of roughly 10%, a paper gain of 33%. That's a risk reward ratio of 1 to 3. I would say that strictly by the results up to now, this group of people has been right twice. What is interesting to me now, as it was back then, is the demographics of this group. The average net worth of these people were £5 million, which was at the time roughly about, I believe, $6.1, $6.3 million. And the average age was 61 years old. And at the time you said, well, that's a smart money. And I replied to you during the interview, well, I do not know if that's a smart money, because maybe there are other people who have accumulated $100 million or $500 million, and maybe that's a smart money. But definitely, no question about it, it's the experienced money. If you're 60 years old, you have accumulated in your lifetime a minimum of $6 million, probably most of the choices you made in your life were correct. And the second point I had made to you at the time was that it was my assumption that if you're 60 years old, you have a net worth of over $6 million, then you're not trading, planning to pay your rent with your stock market gains. You have already accumulated wealth. What you really want to do is preserve what you have. You've been around for a while, you've learned some lessons from life and investing, so what you care about is to preserve your wealth. Twice the last 20 years, this group of people has been right. So to make a long story short, it's been long, we have been speaking about 20 minutes now. Just like a couple of years ago, I thought that was very interesting research, and I got the permission to share with our listeners a small part of it. The last few months, I have come across a research that is equally interesting and fascinating. It comes not only from a very good and very respected friend of mine, but also one of the most astute investors I know, and actually the most knowledgeable person I know regarding gold and silver mines. It has to do with junior silver miners. Again, there are two aspects to this: the intellectual and the factual. The intellectual, and I'm not going to get into this, I'm going to leave it up to each individual investor to decide, is that the actions by Congress and the Fed will result in inflation and perhaps hyperinflation. Then gold and silver will enjoy higher prices. Given that the ratio between silver and gold is the highest it's been, I think, like 60, 80 years, then perhaps one would expect silver to rise more in relation to gold. In that case, how do you benefit? Do you just buy silver? Do you buy gold? Do you buy gold and silver mining stocks? Perhaps all of them. How many people know that during the last gold and silver mania that we had 40 years ago, during its last 2 years, from 78 to 1980, on average, junior silver mining stocks gained 2,000%. That's a remarkable number, isn't it?
It is incredible. And the only way you get returns like that is either by taking huge, gigantic risks in the futures market or something, or by having call options that go up in your direction.
Yes, as I said, I was privy to see a research by someone who not only is a good friend of mine, but actually is the most knowledgeable person I personally know when it comes to silver and gold mining stocks globally, and one of the most astute investors I personally know. I'm only showing just one small piece of the research. If you saw the whole thing, you'll be amazed. And the point is, assuming that gold and silver do rise. Perhaps you cannot put 100% of your money on, based on this assumption. I wouldn't. But would I risk, let's say, 5%? Would I risk $5,000 of a $100,000 portfolio to make 50 or 100K? Well, that makes sense to me. However, according to the research that I saw, I must say this. I must warn of this. There are about 25, 14 junior silver mining stocks right now that over the next 2 to 3 years could indeed rise 10 or 20 fold if silver was to rise to 50 or above. One thing that I do want to point out is this. Just because a silver mining stock is selling for a few pennies, it doesn't mean 2-3 years down the road you'll make thousands of dollars. I can tell you that for every one stock that has the potential to rise 10 or 20 fold, there are 20 stocks that will probably go to zero over the next 2 to 3 years. The key thing here is to understand that the best way to leverage a rise in silver is perhaps through junior silver mining stocks. And the second thing is to understand that not every junior silver mining stock is going to be a winner, but there are quite a few that can make it. And what I suggest is take a look at it, research the idea, and do your homework. If you don't have the knowledge to do your own homework, seek the advice of people who have a proven track record in the area. But intellectually, if you believe that gold and silver will rise, perhaps you may want to risk 5% of your capital in junior silver mining stocks. And if you don't know how to do it, seek the advice of people who know how to do it. So that's the idea of the day.
And I bought junior miners in the past, but I'm focusing a lot more myself on them. And a reason is, as you mentioned with these people you said are over 60 in this survey, I'm not 60, but I've been now doing this for over 25 years, almost 30 years. But the first time I bought a mining stock was in 2002, and you didn't have the exchange traded funds back then. And when you're younger, you want to gamble it up more, make money faster, take bigger risks, and so forth. So for several years, I focused on trading in and out of these mining stocks with just about 100% of my money. I'd buy like 20 of them or something, and if I thought the market was going to drop, I'd sell them all, and then I'd go 100% in and so forth. And I did this until 2008 in the summer, and I made money, over the years doing this. But then I looked back and I found that if I'd only put 20% of my money at the start in these stocks and held, I would have made just as much without as much stress and risk. So the trading in and out with giant positions or taking big risks isn't necessarily the key to the big gains. And today, what I'm do is, as you said, maybe the right thing to do is own the metals, own big miners, then some of these. That's what I'm focused on, doing all this, but with a smaller amount of my money altogether, for sure. And a lot of people over the years I've seen have tried to get into these triple ETFs because they move so much, and now they malfunction in March and no longer really work. They're no longer triple ETFs even. The promise of the big gains, turned into disaster in those because of what happened. To make a long story short, what I'm doing is putting a percentage of my money into gold and silver ETFs, a percentage into large mining stocks such as Newmont, that in this money I just plan on holding for years, not jumping in and out, because I think we're in a bull market that's going to last for quite some time. I don't want to try to trade it like I tried it in the past, but just hold a core position, but to try to make to make the larger amount of money buying some of these small junior mining stocks with a portion of my money, also not a large amount, because they can act as call options to go up so much. You don't need to put a large amount in. As in your example, 5%. If you risk 5% and it works, that's a huge return over time. So that's why I think these stocks are exciting, because you can risk a small amount to try to make a big amount. You don't have to do anything complicated in futures or exchange traded funds and so forth.
Over the next few months, I will get the permission to feature some of those stocks. I know you and your partner, David Skorica, have spoken about some of those stocks. So if you're interested, subscribe to our channel and stay tuned.
For sure. Great talking with you.
Thank you, Mike. Have a good day.
And you too in there too.